think I'm about live here.
You might lose me just for a second, Julie. I'm going to get off my iPhone and linking in on my laptop here. So
Okay.
here's the small glitch. Just
All
like
right,
that.
we're live now. So, all right.
We'll wait for you, Aaron.
Okay. Okay. Good. I can open up something else. So, get rid of this. Okay, let him in. So.
All right, I'm good.
Okay, I'd like to call the Economic Development and Airport Committee meeting to order for January 19th, 2021. Members present are Mr. Ivy, Ms. Earlston, and Tom Fellner. Do we have any, excuse me, could we have a motion to approve the minutes from the last meeting?
I'll make a motion.
Go ahead.
Mr. Ivy makes the motion and Ms. Earlston seconds. All in favor? Aye. Minutes from the last meeting are hereby approved. If there are no additional agenda items, I'd like to hear a motion to approve the agenda as presented.
I'll make a motion to approve the agenda as presented.
Ms. Earlston makes the motion and Mr. Ivy seconds. All in favor? Aye.
Aye.
Motion carries that the agenda is accepted as presented. We have one agenda item, and that's a Freeze Center discussion. Julie, is Mr. O'Leary on?
No, he was in the other meeting, and I told him to go in the other meeting, but I haven't seen him yet. So maybe I'll go and maybe invite him.
Okay.
Try to get so.
So, with us, we have Chad Miller from the Port Authority and Mr. Frankhouse. And also I see Michael DePerna. Is that how I'm reading that right? Okay. So Chad, you sent some paperwork over from the Port Authority. Would you like to initiate the conversation?
Sure. So the information that we sent over is what we are presenting to the committee and would like the committee to forward to council as our, I guess, financing proposal for the Freeze Center. We do have Michael DePerna from the municipal advisory firm that helped us draft this on the Zoom with us. So I would like to, if he is willing, have him explain the financing structure for the committee. Michael, would you be able to do that?
You're muted still.
Sorry, thank you for reminding me.
Would you like me to share this document on the screen? I can't do
Yeah,
that.
yeah, if you would,
that
yeah,
would be
sure.
great.
Okay.
I think also I'm going to have Doug walk through the details, but from a simple concept, we're assuming the Galleon Port Authority issues a $5 million bond that is purchased at 3.5% interest rate by the Freeze Foundation. And we will show that we start with a corpus of around 11.6 million. They liquidate $5 million. They buy a bond for $5 million. The city accesses their draw each year from the freeze fund we use 5.14%. Then the city uses that draw to pay or to deliver funds to the school for their scholarship funds. And they pay the debt service on the $5 million bond at 3.5%. And that goes back to the freeze fund. And what we try to show is those interactions, the bonds issued, the bonds are repaid, and how that money is, if you could scroll down,
Okay.
please. Yeah. Just keep scrolling down. This is just the bond schedule. I think you want to go to Schedule A. Yeah, right here.
There.
Exactly. Yep. This is where we want to be. And Doug, if you were on the phone, correct?
Correct.
Okay. Why don't you walk through it? It's a little complicated maybe when you first look at all these numbers and what we're trying to show here, but I think it flows fairly well, and Doug will be able to walk you through all of the individual pieces. Again, we issue a bond, the city draws from the Freeze Foundation to pay the schools their component. They take whatever component they have available. They pay the bond debt service. It goes back to the freeze fund, and over time, the bond is repaid from the corpus and the earnings of the freeze fund. So Doug, why don't you just walk through this very quickly? But that in concept is what we're talking about doing.
Sure.
Hey, Michael, could I just say something real quick before Doug goes?
Absolutely.
Said a word liquidate, which I want to ease everybody's sense of nerves with that, because when that money is liquidated, it's then you turn around and buy that bond, the freeze fund does. So the fund at that 11.6 corpus that Michael referred to is kept whole. So when you make that draw at the 5.14% annually, it's based on that 11.6. I think that's really important to note before you jump in. So thanks.
Sure. Yeah, go ahead, Doug.
I guess instead of liquidate, it might be better to think of it as a reallocation of the 11.6 million of where it's at. If we take a look here, I have the first starting date, January 1st, 2021. That is the balance of the fund based on a statement we had received from the fund manager, which we obtained from the Port Authority. That 11.6 million right there. So we're saying if we were to close on the bonds in July 1st of 2021, you'll see the starting separately managed account balance, column A, if you will, okay, is now at 6.6 million, and $5 million of that has been reallocated to purchase the $5 million of port bonds, as shown in column B. Okay.
And at that, let me just add, at that point in time, $5 million of cash, because you're taking, of the 11.6, you're taking $5 million cash and buying the port bond and giving the cash to the Port Authority so that they can construct the facility. But what you're replacing that with is a $5 million bond. So you have the 6.6 million of the corpus, and you have a $5 million bond, both sitting as investments in the freeze fund.
Right. Yeah, they're all still invested. The estimated return on the freeze fund we were given as 6% annually. So that is the return rate shown in column C. That is the return off of the $6 million. Okay, the amount that's sitting in the $6 million account.
6.6.
6.6 million, excuse me, yes. In column D, I show the 5.14% draw. That's the annual drawn down amount by the city. That is the 5.14% off of the amount shown in column G. So that total corpus, again, that 6.6 and the $5 million combined. Okay. Moving on through, As the bond payments are made, the principal and interest, that debt service payment will flow back into the freeze fund, which is why it will help contribute to the freeze fund growing in its balance again. Okay. And moving on, of that 5.14% draw from shown in column D, 1/8 of that is allocated to the schools. The remaining 7/8, the Port Authority is proposing that we first use that remaining 7/8 to pay the bond debt service. And again, that's going to be the principal that's due plus the interest of 3.5% interest. And then the remaining amount after paying the debt service will then flow to the city.
So Doug, can you point out those columns where that?
Absolutely. Yeah, sorry about that. So column H is the school's allocation, which is that 1/8 of the total draw. So column H is 1/8 of what the amount that's shown in column D. Column I is going to be 7/8 of what's shown in column D. That is the amount that goes to the city. And as the bond debt service is due, you'll be making the payments shown in column J. Okay, that to pay the bonds, and the amount paid in column J is what winds up being shown in column E previously, because that's flowing into the Freeze Foundation Fund. That's replenishing it.
The
Okay.
bond of $5 million now being repaid.
Correct.
That's all that's happening.
Yeah.
Right.
And then as a result, after you pay the debt service, as shown in column K, that is the amount that will be the residual amount that will be flowing back to the city after the debt service payments have been made. So it's based on current projections, it's still all positive, meaning that the city will be able to use its own allocation, pay the debt service, and still have additional funds to purpose for other projects for the city as the city desires. As these payments continue, these bonds are paid semi-annually, and it's projected that by January 1st of 2030, the corpus amount, the amount shown in column G, in January 1st of 2030, that is when it will finally grow back to the corpus balance today. It's the amount shown in that like bold highlight row there. Yes, correct, right there. That's when the corpus amount gets back to 11.64 million, which is what it's at now. So that it will take about 9-10 years based on these projections, that 6% growth rate that we were given, and assuming still same 5.14% draw. If you are talking about when the amount that's not associated to the bonds returning back to that 11.64 million, we would be looking at January 1st of 2040. And that is shown in column F. January 1st, 2040 is when the amount in column F returns back to its current levels. Okay. So at that point in time, the freeze fund corpus amount will be 12.1 million shown in column G, of which 11.6 million is in this in the current investment allocations, and of which about 500,000 is invested in these port bonds, because that's the amount of principal that is still outstanding at that point in time.
So that's the projection based on a 6% return of the existing freeze fund corpus.
So I'd like to take just a moment here to kind of explain why we settled on this proposal, this scenario. There were several factors that we took into account. One being cost to finance this project. Privately placing these bonds with the freeze fund will allow us to save money basically in interest expense. If we were to try to make this a public issue, bond, we're going out and trying to sell these bonds on the market, or even privately placing it with other entities, individuals, more than likely the interest rate would be much higher than what you see in this scenario, which would make it a lot less feasible, a lot less, I guess, a lot more damaging to the freeze fund itself. So the second thing that we really wanted to take into account was to try to keep the balance of the freeze fund intact. So, we're not asking for liquidation and give us cash. We're asking for a reallocation where the city is going to pledge some of its draw to pay for the debt service. But keeping in mind that, even if this free center never is able to contribute ever to the debt service, which we anticipate it will be able to, by year 10, the fund balance is back to where it is today. And the third thing that we also wanted to take into account was to make sure that whatever steps we took would have little to no impact on the scholarships that are being offered by Galion City Schools. And we think that this scenario, that this proposal accomplishes that as well, where the schools will still have the opportunity to see that full 1/8 go towards scholarships. The only thing that this scenario does not present is something that we had talked about in the past, that we do anticipate a debt service, I guess, I don't know if you want to call it sharing agreement between the port and the city, where at some point in time during the schedule, whether that's year 5 or 10, the port starts to pay a portion of this debt service, which would then in turn free up additional cash for the city for other projects.
Questions? Go ahead, Ms. Earlston.
And I may have asked this question before, but this is all based on a 6% return, correct?
Mhm.
And
Yes.
how did we come up with the 6% return?
I think that was the historical return.
You called it reallocating, but the Freeze Foundation is going to contribute $5 million cash toward the purchase and another $5 million toward bond.
No,
Okay,
this is the only contribution. It's not, it's basically what we'd be asking the trustees of the trustees of the foundation and its current advisor is to, whatever their portfolio is now, whatever it's comprised of, they're going to have to probably obviously liquidate some of the investments they have currently to purchase these bonds. So we are not asking them for any cash, if you will. We're not going to reduce the value of the overall invested balance. The overall invested balance is going to stay the same. It's just 5 million of that is now going to be bonds that they've purchased from the port.
so they're going to
Yeah,
purchase the bonds
yeah. From the
Yeah,
port.
from the port.
Let me,
Okay,
yeah, let me give you just another example, if you don't mind. Let's say you had $11 million of cash in the freeze fund. They're going to take $5 million of cash and give it to the Port Authority. So the port has their 5 million cash to build their facility. In return from that, they're going to take a bond issued by the Port Authority, which is $5 million. So you have 6 million cash, $5 million bond. That bond's generating 3.5% per year. And that's being paid from the city's allocation that they take, which is 5.4%. Okay, that's a different visual, hopefully, that you can see.
yes, I think that makes it a little bit clearer.
Okay.
So I'm going to try and rephrase that to see if I have an understanding. The Galleon Port Authority is going to be a part of the Freeze Foundation's investment portfolio.
Yeah, the investment portfolio is going to own a bond of
Okay,
the Galleon Port Authority.
okay,
Be no different than the Freeze Foundation buying a US Treasury for $5 million.
okay.
Okay, they're
So,
buying a port bond for $5 million.
And so Chad, that's what, one of the things you were referring to when you said that by doing this way, it would save an outside bond being purchased.
Yeah, let me explain that if you don't
Thank you.
mind. Sure. So the alternative, if the freeze fund does not buy the $5 million bond, is the Port Authority has to go out into the market and issue a bond for $5 million, right? So the question is, who's going to buy that bond, first of all? Is a bank going to buy it? Are you going to be able to sell it in the marketplace? And we project that the rate would be higher if you have to go out and sell it in the marketplace. Okay, versus if the freeze fund buys it at 3.5%. All right, and what that does, that's about the optimal level where the city's taking all the risk, quite frankly, to pay off the bond, right? Because they're taking their 7/8 draw from the freeze fund that they get every year and paying the debt service. So you know that money's definitely going back into the freeze fund. It's going to build the corpus of the freeze fund as the bond decreases and you pay that off. It's a 20-year bond. So in 20 years, basically, you've paid yourself back the $5 million at 3.5% from the city's draw. Okay, you've paid back the total freeze fund, the $5 million bond that the freeze fund bought today. You paid that back over 20 years. So in the end of the 20th year, that bond is down to zero. And the freeze fund, again, if you just had cash forever, the freeze fund will have this set $11.6 million of cash at that point in time. In theory.
Aaron, do you have anything?
I do. I'm just trying to articulate an approach and the way to phrase the question. So there's just a lot of information. I was looking at the email that we received about 2 hours before the meeting tonight with a one-page presentation of just a simplistic breakdown of the different options of liquidating $5 million versus doing the bond through the Port Authority. And, you know, I can definitely see positives in both. If I'm understanding this correctly, I'm not trying to make light of it, but we have an opportunity to keep the money in the freeze while it's accruing interest over the years, secure it basically through a bond at no cost to the taxpayers in any way, shape, or form. And the only element that we're dealing with is a risk, which it seems through this option seems to be as about as minimal as it can be. But one question that I came up with is that kind of piggybacking off Tammy's 6% question, what has the, over the past couple of years, somebody from the port, what has the return of interest been on that, on our account, or the freeze account?
So that is a very good question. And I don't know that we have the exact answer to that because we do not have access to enough financials for the fund to be able to say that definitively. We've only gotten snapshots of fund balances at moments of, at different moments of time. So it'd be really hard for us to estimate what that return has been or the average return over a period of years has been.
Hey,
Michael. Yeah, I thought we got that information 6 or 7 months ago from KeyBank. I thought we did.
We might have. We might have.
We got some kind of average return. Doug, do you recall?
I do recall receiving something like that. I am trying to see if I can dig it back up.
Yeah.
But they did give us a projection at the time, and I do believe it was actually a little higher than 6%.
Yeah, I thought it was as well.
Closer to
Yeah.
like, I think 7 or 8, and we
Yeah.
picked 6 to be conservative. But
Yeah.
obviously, it's
But-
a projection, but yes.
Right.
Hey, Doc,
Yes.
Hi, Tom.
ask Michael a question.
Certainly.
Okay. I think this goes back to Tammy's question. If the fund doesn't earn 6% on the other half of the money, at what point does the debt service begin to be a real problem? In other words, if you
Yeah, I
don't
hear you. Yeah, I
percent,
understand. Yep.
Okay.
Doug, we actually anticipated that question.
oh, really? It was an
Yes,
easy
of
question.
course. I know, but we
You know it's
a
coming.
good problem solver looks ahead, right? And solves problems before they're problems. So
Yes, sir.
Doug, what's the break even on that?
The break even comes out to about 3.68% ish. That is when
So,
sorry,
yeah, that's when
Um,
you start eating into the corpus to pay for the city's
Right.
draw. Okay, so if you can earn 3.6%, in theory, you would break even. You wouldn't ever build the corpus until all the bonds are paid off in the 20th year, and that's when it would be break even. So if you earn 2%, the city's gonna start eating into or being a little short of making the debt service. And the city would have to make up the difference. Or the freeze fund would have to take, less than 3.5%, and it would be an accrual, or, we'd have to figure out how to deal with that.
and let me just clarify that. Excuse me. Let me just clarify that a little bit. The 3.68% that I was giving is the lowest that it can be, where we would have a city allocation that was inadequate, like insufficient to pay for the debt service in a given year.
Gotcha. That's what I
During
thought.
that time, the corpus is still shrinking because the city is drawing 5.14% off of the entire corpus, whereas the earnings, of this 3.68% is only off of the 6.6 million that's in this separate account. The $5 million bonds are still earning 3.5%. So there's a couple different sensitivities to look at, but yes, that's kind of like your absolute, like, at this point, there might be a debt obligation from that the city may need to somehow make up a shortfall. And that debt obligation would occur like very close to the maturity of the bonds. We're talking like 2040, 2041, when this would first occur.
So explain that. When you say 2040 or 2041, what do you mean
Right.
exactly?
So
Explain that, because I don't understand that.
Okay, sorry about that. If the freeze fund returns, and again, this is the amount on that 6.6 million, we're at 3.68% on an annual basis. Over time, we're actually chipping away and bringing the corpus balance down because it's simply not keeping up with the 5.14% draw that the city is making every year. So as that goes down, your total returns shown in column C, estimated returns of the fund, is going down as well. Okay. And with that going down over time as well, what I'm saying is it will come to a point where the return on the fund is not enough to cover the debt service on the fund. And so we would actually have a shortfall. Like the return on the fund is going to be like 195,000. And then the debt service was like 200,000. So at that point we would have a shortfall. That's when the city would need to make up the shortfall. But,
on an annual basis, correct?
correct.
Yeah, right.
Yeah, so it's
So-
like, yeah. Yep.
I think it's a fair I mean, I really think it's a neat structure, Michael. I'm glad the idea of incorporating the fund, the foundation, purchasing some of the bonds, that's really core. I think I remember that, that one morning or at some point, that notion of doing that, I think
Right.
it really helps make a big difference. Obviously everyone or everything is held harmless except for the city's likely residual or what's left over to do freeze projects going forward. So I don't think that's for Doug and for Michael to weigh in on, but that's really one of the entities that for 20 years, the city is going to have much less available for future freeze projects.
Well, that's true, unless the facility itself makes money, right? So let's
Sure.
say, right, let's say the facility makes excess 100 grand a year. Well, that's going to go towards the debt service first. And then your debt service will be less than the total debt service amount. So you'll get that extra residual as well. So
Again, I
mean,
like the structure. I remember it from
right,
like a year and a half ago. It does
right,
allow for sharing on the if the proponents are right and this produces a lot more revenue than the skeptics or cynics, then it really all
Right.
of the upside and the ability of the port to contribute to debt service will change what
Right.
you presented real significant.
Yeah, absolutely.
So I want to bring
right. Yeah. So
that
instead
gets
of,
in the depth. Yeah, but that gets in the details of the city and Port Authority agreement about how, at what point we identify excess revenue that would go to debt service from the port. So I think it's a reason to keep exploring it, but it's not a reason to stop or
Right.
shoot it down any.
yeah, right.
If I could just add something real quickly, some information from that SFA study that adds credibility to the Freeze Center to be able to jump in and be the first to make payments towards the debt. So it frees up more money for projects. You know, skip years 1 through 5, the first 3 years, it's projected to lose money. It makes money in years 4 and 5. But the average for years 6 through 10 is $112,865 a year. And then years 11 through 20 is $171,000 a year. So these are projections, we get that, but we use probably the most reputable firm in the country that looks at these types of facilities. So I think what Chad initially said, I don't think you were on the phone yet, Tom, but he made comment that the freeze operations could kick back, whether it's to debt or to additional projects and monies needed if there is a shortfall.
During the, again, I'm going to kind of try and rephrase what I thought I heard. Annually, the city obtains freeze funds. And that is a percentage, not sure how it's calculated, a percentage of what you guys are calling the corpus or part of their, not explaining this well. We get a sum of money, the 7/8, 1/8 that we can use for the projects. That's the money which will service the bond. Is that correct?
That's, yes.
Okay.
Yep.
And,
Yep.
And will there be money left over
Yeah.
in any given year to
Yeah.
do
Go-
freeze projects, albeit fewer?
Julie, go back to the flow of funds, if you don't
Oh,
mind,
are
that
we
Schedule
doing-
A,
Yeah,
or would you please?
is it sharing? Oh, no, I forgot the button, sorry.
Yeah, so I think, Doug, which column shows the
Yes.
excess that goes to the city?
The excess that goes to city is column K.
Right,
Okay.
so of your 7/8,
Which is in
If you-
column I.
yeah, if you earned 6% on the 6,000,006 plus the 350 on the 5 million, this is the excess that goes to the city every year. This is semi-annual, actually.
Yeah.
That's the excess after paying debt service. All right. So again, the big assumption here is that over in column A, day one, you have $6.6 million of investments because you had 11. I'm going to use the word liquidate, but don't let that scare anybody.
I think you froze, or did I
If
freeze?
you have cash in account, we aren't going to liquidate
There is.
anything. Okay, we're going to give the port 5 million, and we're going to put $5 million bond into the corpus, which means body of the freeze fund. All right, as long as we get 6% on the 6.6 million, these numbers will pan out. It will work forever. You'll have your excess of about 85 grand every semi-annual period to the city. All right.
Mr. DePerno?
Yeah, one more point. That's if the facility doesn't contribute one dime to the debt service. All right. Yes. Who was going to?
Yes, this is
Yep.
Aaron Ivy. Would you consider that 6% a very conservative, more of a centrist, or more of a liberal, so to speak, I
Yeah,
guess?
sure. Well, I think in today's world, it's probably a little aggressive, quite frankly. But I think the past, they were getting way above the market. Key's investing this for you, and they were getting, I'm pretty sure it was 8 or 9%. What I can remember. So to get 6% today, it may be a little aggressive, but it's probably doable.
Thank you.
Sure. But again, Doug, maybe what would be helpful to the city and its council and the mayor is that if we run the break even, we ran it, of course, but we show where that net allocation to the city goes, what's the rate go down to in order to be zero? And that will tell you in a sense where your break even is. So if in fact it goes to zero and let's say it's 68% is what you have to earn. If you earn more than that, you're always going to have an excess in column K. If you earn less than that, then the city literally is going to be short to pay the debt service. So that's the guess and the analysis that we have to do, you all have to make. And is that reasonable or is it not reasonable? That's really and this is really probably the only way this deal's getting done, to tell you the truth. We won't be able to go sell a bond out in the market without the city backing it, okay? And Tom and I talked about this, Gary and I, Chad, we've talked about this. Because people don't just buy bonds based on, quote, speculative revenues, which the facility, all the revenues are speculative today because we haven't generated any revenues. So it's going to be, this is probably the only way this deal's getting done. I hate to boil it down to that, but no use going off on tangents and picking even more and more difficult structures, because this is a pretty good structure as long as we can get the earnings on the fund.
Doc, can I make a couple more points, please?
Certainly.
Hey, one of the things is this whole thing swings on or is contingent on the freeze board agreeing to go ahead and be one of two entities that will take, without mixing metaphors too much, but a couple entities will probably take a haircut on this. One is that the Freeze Foundation will agree to take 3.5% or some number like that for a return on half of their endowment. Okay, so that's a haircut that they'll take. They could earn more than 3.5%. Hell, we think, well, the rest of the fund will earn 6%. So,
Mayor,
That's
can you
one-
clarify that for me, please?
pardon me?
Can you, I'm sorry, can you clarify that for me, please, what
Yeah,
you just
well,
said? Give me a good example.
If you don't direct, or if we don't have the agreement of the foundation to buy $5 million of 3.5% bonds, then they would otherwise make more money. So they'll take a haircut. They'll have less income by doing it that way. So that's one entity that's going to have less, but will the community have more? I think proponents think, yeah, that this will be a lot better for the community. But the Freeze Foundation is going to have less income if they participate in this deal, likely. Unless in a really bad sense, the 3.5% is less than what the market earns, but
Could be.
that gets into like
Yeah,
kind of
But,
detail,
but
not
the-
worth.
right, but the alternative is even worse.
Yeah,
So, right, yeah, if the freeze fund takes a haircut from 6% to 3.5%, yeah, that's a haircut. But the alternative is that the only way you're gonna get this deal done is if then the city steps up and backs the bond. If we're gonna
oh yeah, I
sell
don't,
it
yeah,
in
I
the
agree
market.
with that, Michael.
Yeah, I know you do. I just wanted to
Yeah.
point out the contrast there, okay? And in that case, then we're just gonna be paying more interest out the door versus 3.5%. So what we really studied and selected a structure that is almost a balancing act, if you think about it, between, okay, what are our alternatives? Our alternatives, there aren't any better alternatives. This is really the best structure that we could put together. And this is why we presented it this way.
Yeah, and I think that the freeze of trust, it will be open to a discussion about taking less of a return on their investment than they could probably get in the market. I think there's been enough conversation. I feel confident about that.
Yeah,
The other thing I wanted to mention, Doc, is that the city obviously is going to take their haircut. And I
Yep.
think that's the thing. What you're looking at is about $80,000 a year if the projections go forward that we as the city will have for future freeze projects or maintaining previously funded projects. So that pool will go down. To be honest, Doug, I don't know if you're the guy who did this, or Michael, or both of you, but I'm surprised or pleased, I guess, to see that there's 185. I thought what would be left over once you held the schools harmless, which is another virtue of this plan, that it's hardly, not to be a crap head, but it's like, you get under 150,000 these days in recreation projects. That's not much of a project. So I feel okay about the other haircut. If as mayor, I had to go and get a haircut, 185 or something like that, that probably allows us to do, gosh, 20 years is a long time. And so the very last thing I'd say, Doc, is that negotiating that agreement with the port, so as they produce more revenue, like the advocates of the project think it will do, that there is a mechanism that the city, as the port generates more money off of the freeze center, that they contribute a predictable increase in in that percentage of debt service.
yeah, agreed.
Well, yeah, sure. Ms. Earlston? I think you're on mute.
Sorry, I raised my hand and then I couldn't get it to unmute. Mr. Mayor, you were saying that the haircut 100, was it 180 you said? Tom?
Yeah. Yeah,
And that is, you're basing that on the approximate amount that we use from the freeze on a yearly basis.
yeah, Tammy, if you look at the whatever line K, I think it was.
Yes,
Yeah, twice a year on this debt schedule, we'll get 75 or 80,000 bucks a year. And
Twice a
that'll
yes.
be the money that we'll have.
Oh, I was confused on that part too.
So we're used to getting 450,000, we'll be back to 185.
Exactly.
May I
Right.
interject and piggyback off that? I, like the mayor, I think if I was understanding that right, I was kind of pleasantly surprised that the number was as high as 185. I kind of anticipated it being lower as well. But yes, that, to me, that sounds, if you look at the big picture of everything that we've done in the parks over the last 8 years and how fantastic they look, you know, if we're looking down the road, maybe 185,000 or maybe a little more if we get bigger returns, would be reasonable. We've done some major projects and, you know, maybe some of the things we have to do in the other parks won't be so expensive, so to speak, as far as big capital.
Oh my gosh, Aaron, it'll be crazy expensive, but we'll make it work. Here's
Yeah,
the thing that I think.
That's what I was gonna, okay.
Yeah, I'm sorry to cut you off. Go ahead, please finish. I'm sorry.
I was
'cause
just gonna say, I was just gonna finish up by saying that, you know, a lot of smart people that are goal driven with one thing in mind. I have no doubt that we can make it work. But I digress. Go ahead, Mayor. Thank
No,
you.
what I wanted to say is that the city coming in to make their contribution, I think really works well. And I'm going to go back and reinforce a point I made a few minutes ago. And that is that the first haircut, that being of the Freeze Foundation, if they're willing to expend, you know, to take half of the endowment and then roughly, or a little less, and invest it in these bonds and agree to pay quote unquote only 3.5%, then we have a heck of a deal. I think, you know, once if we get into a negotiation, we as the community, and well, we don't like 3.5, but we'll take 3.75, or, you know, that starts to make this an even thinner deal. So I think it's important to hope that the Freeze Foundation Board accepts that. I'm going to get the number wrong, but it's 3.5% on the bonds, right?
Correct. That's what we used.
So if they don't accept 3.5%, we start dickering back and forth. This thing gets a little bit, you know, I think if that were to happen, folks that would say, well, you know, they can't make up their mind would be wrong. I think what we may find, and I hope it isn't the case, but I think that 3.5%, Michael and Doug are right on this. I think that's a fair rate of return. And, you know, it's an expression of whether the community wants to do the project.
Yeah,
They
absolutely.
don't
I
wanna
agree with you.
We can't do the deal.
Right. I agree with you, Tom. I
Well-
really do. Yeah.
One of the scenarios, if I recall, in the past, was to accept money from the Freeze Foundation, convincing them to gift us X amount and let them build back the corpus themselves. And so we were still in that scenario, we were going to receive less money annually from the fund because that balance was cut in half, and they had to go out and make sure, wait until their investments built up after 10 years or whatever. I think there was a projection that maybe Mr. Watkins had said that eventually, you know, with their rate of returns, they would eventually be held harmless. And, you know, this way, I mean, this is the first time that I kind of understand the financing. So thank you, gentlemen, for explaining that. But I think that I'm excited that this is doable and reasonable. And of course, anyone who would think a project like this is risk-free is a fool, but I believe that the risks are at least laid out and understandable and in my mind, acceptable. So, I mean, that's just a personal opinion. I'm very happy with what I've heard here tonight.
And
Hey,
just,
Doug, may
Ms.
may I
Wilson,
ask Doug another question, or Doug or Michael another question?
shh,
What
yes,
what is the number that they quote, listen to me, the Freeze Foundation will forego by doing this deal? So we're assuming 6% on the residual. If they had just kept everything at 6%, what would they earn versus investing half of it in this measly 3.5% sports project? I don't know if you have that number, but you can definitely get to that pretty quickly.
Well, if they kept $11.6 million, their portfolio as is, $11.6 million, and earned 6%, they would earn $696,000. All right. So in this case, right, so keep that number in mind. And then in this case, they're earning 6% on 6.6 million and 3.5% on 5 million. So whatever that will total up. Let me just do that math. Doug, is that in here somewhere?
yeah, if you take a quick look at
Yep.
the row that's dated January 1st, 2022,
Yeah.
column C,
Yes.
you see 200,901.
Yeah.
That is the amount that where they made 6% on the 6.6 million and
Right.
then 3.5% on the bonds.
Where's that at? Where's 3.5% on the bonds?
3.5% is the amount shown in E.
Okay, so those two total 6.96
Yeah.
versus what, 375?
Yeah. Well, sorry, take out yeah. If you take out
Is
the
that
principal,
it?
I should say, I guess more accurately for the corpus difference, if you will, it's going to be that 200,000 shown in C plus the 87,500 shown in M, the interest amount, because the principal is just a repayment of corpus. It's not earnings, if you will.
Those are semi-annual figures too, though. So you got to double that.
So not annualized.
Yeah.
Well, let me do the math for you again. So
It's
I'm
like
going to
560.
simplify.
It's like
Let me
560.
just-
I think.
Yeah, let me just dumb this down for myself here. So if you do nothing and they earn 6%, the corpus is going to earn $696,000. Okay, this is back in a napkin, but this is basically correct.
I'm with you, Mike.
696 grand. If you do,
Oh, shoot.
I don't think that's me, is it?
No, he froze again.
Okay.
That was a bad time to freeze.
I
Yeah,
know,
we're
we're
gonna have to-
always getting him out.
It's getting good.
is that a pun?
Yeah.
Sorry about that. Let me just go and continue this point then. Yeah, it off of 11.6 million, if they were earning 6%, that's 696,000 roughly a year. If 5 million went to, is earning 3%, and then the remaining 6.6 million earning 6%, you would be making about 546 million.
Yeah.
That'd be the difference.
Yeah.
Okay.
Yeah.
546,000.
Oh, sorry, it's 546,000. My apologies. Yeah, sorry about that.
so
Yeah.
yeah, I
Been a
live,
good year.
No, that's good though. That is my point, y'all. That it is not a huge difference
yeah,
between if you just let it sit there, and not to be jerky, because I know there are Freeze Foundation folks on there. We generally get 5%. That's the yield we get. because that's what the IRS requires them to distribute to the beneficiary. So it's it isn't to complicate or to, throw cold water on it. It's to say if we were to do nothing, we wouldn't be a whole lot further ahead.
Right.
Yeah.
Well, you wouldn't even be ahead because you wouldn't have an $8.5 million asset making
Yeah.
$10 million per year, bringing 43,000 people to the community. So we're behind.
Yeah, I'm not gonna argue that.
I know you don't like that, but it's true.
No, I don't.
So-
I'm just saying that it is, when this works, when you take a real bearish approach, I think it adds confidence to people who are skeptical about whether it'll work. It's
Yeah.
really a cool deal, Michael. You and Doug should
Yeah.
like
So,
promote
let-
social distance.
yeah, I agree. So
Hell of
I
a
don't
deal.
know. I don't know where did I get cut off? I live in Westerville, which where I live, must have the worst connections because I get cut off all the time. And you would think we would be like in the midst of, fantastic internet, but so I don't know where I got cut off, but I want to finish this.
Well, Doug
this
said, I
thought
think it's
for you all. If
185.
you
Is
do
that
nothing,
the
you're on
difference?
6, and this is the back of the napkin.
150.
I think he froze again.
Oh, no.
Oh, gosh.
Michael, you ought to move up to Galleon. We've got good.
It's
In a great
2.5%
potential
of
housing
5
market.
million is what it is. Just if you guys want to do an easy calculation, it's 2.5% of 5
Yeah.
million. Because
But
we're
anyway,
reducing
it's
the
5.7. Well,
Yeah.
anyway,
There you are. You're back.
yeah. Okay.
Ms. Earlston, you had a question?
Yeah, so first off, I want to say that whenever we're discussing something like this, like a project of this magnitude, it is really important to me to understand not just the positives, but also the risk involved. So I really appreciate being able to hear the risk, because you can't look at something like this without considering risk. And I previously wasn't able to really hear that. So that, believe it or not, hearing risk makes me feel better, because then I, can look at the whole picture. So first off, I just want to say that. And then second, the amount that we're looking at that would still be coming to the city that we were just discussing through the freeze, again, just kind of questioning, is based on that 6%. If that's not what it's earning, that would also be less, correct?
Yes.
Okay.
Yep, if you don't earn 6%, that 90,000, 86, 88, 89, that goes down.
And you felt that might be a little bit,
Well, I mean, in today's world, if you can get 6%, that's probably decent, right? I mean,
yeah, okay. Because
So-
I was kind of thinking that as well. So I just wanted to,
yeah.
okay,
But
thank you.
again, this is over 20 years, you know what I mean? I mean, today, if you get 5%, but in year 6 or 5, you start getting 8% like they used to get. I mean, so it's just again, this is all just trying to highlight what the risks are and where the assumptions, could go wrong. But it's taking a middle ground to all the assumptions, quite frankly, in my opinion.
Mhm.
So I'm not saying this is exactly how it's going to work out, but I mean, Tom, when's the first time I started talking to you about this?
Oh, at least 2 years ago, Michael.
Right. So we've been talking about this for 2 years.
Actually,
Um,
Michael, I met you in 14 and I mentioned this
Yeah,
project.
right, exactly.
Um,
So I think, what we have here is a really pretty solid structure. As I see it, you can put your arms around the whole structure because you control it all. And the only variable that really is the dependent variable is this investment rate. Okay, and if the facility actually generates positive income, we haven't counted one dime of that into this analysis. So, those are the two things that you gotta work on. You gotta make sure the facility first you got to make sure the community wants the facility. If they don't want it, then you shouldn't do it. And that's just all there is to it, right? I mean, everyone knows that. So assuming everyone, is in the middle, ambivalent sort of, how do you get them over the edge? Well, can we get a decent return at 6%, and can the facility make money? And if so, here's the results. You could probably run 20 other scenarios, obviously, but this is sort of the middle ground scenario.
Hey, Doc, we were, I don't know what the right word is. I'm gonna have a bad word. We were messing around or dinking around with different structures for quite a while, as Gary pointed out. Michael's been helping for several years. And the idea that you could, that the Freeze Trust could invest in the city's bonds, or in this case, the port's bonds, was a real breakthrough. Because if they're willing to take less than what they could make by investing in, pick your least favorite or most favorite stock, because that's what we're asking them to do, is to take some of the money they could invest in the marketplace and invest it in these particular bonds. If they'll do that, that's a big step. That's a real big step forward. And anyways, I don't know if I added anything to the conversation, but the foundation being willing to take 3.5% will be critical to having all this fall into place.
I agree. And I also believe that the creation of the Port Authority gives us an avenue which we lacked in years past.
I agree with that, Doc.
So I'm trying not to hand out an attaboy to you there, Mr. O'Leary, but
I don't deserve it.
I think that was no, I just think that's an avenue that in previous discussions of this we did not have. And the Freeze Foundation has directly invested in the city, albeit in an unfortunate way. And I feel like when we approach them, it isn't with our hat over our, in our hand and begging, to have a get out of jail free card. This is an investment opportunity, unlike 14, 15, however many years ago. So I really feel positive in that regard. And they stepped up then. So there's
I'm sorry, Doc, I talked over you.
I'm just saying they stepped up in that doomsday scenario. And I think that approaching them in this regard, they'll be hopefully much more amenable to doing that again.
Yeah, I think that's right. And I think we were all, a bunch of us were concerned about drawing down that fund balance. I talked with the city auditor about that. I'm not sure if he's on this Zoom meeting or not, but the notion that's been the city's nest egg, and it got us through. So one thing that's I think very appealing, or what makes this a good proposal, is that it doesn't dissipate, it doesn't destroy that nest egg.
Right.
So I think that was one of the worries of that. Now, let's forget we even used it liquidating any of the fund. What we're asking them is to invest in Gallion's future with the fund. I'm pretty confident that the foundation board, this is something that they can be supportive of. I think the key, Doc, very last point on this is, I think it's important for council to generate 5 or 6, optimally 7 votes. Because I think it's a big project, and I want us to navigate this through so that when decisions ultimately come out of committee and hit the main council, hit council floor, that we have real strong support for the project. So whatever we have to do from tonight forward to make sure that whatever legislation that we can count on 5 or 6 votes or 6 or 7 votes. I think that's one unfinished piece of this that we should work on.
Hey, Thomas, are you still there? Are we still live? It still says live, but I don't know if we're still live.
Yeah, I think you are. I see everybody.
Okay. I know, but my live isn't showing on my phone, so that's why I was wondering if I lost the live. even
The
though it's saying-
Facebook,
Yeah, on Facebook.
Oh, you mean for the
I
other
still-
folks?
I still
I'm
see
sorry.
it. I still see live on Facebook in mine.
Okay,
You got
you
her
can
hand
still.
up.
I
you
do
can still
too.
see the-
Julie.
Huh?
I'm checking,
Thomas,
Julie.
You can still see it?
I'm looking.
Okay.
We are live.
Okay, all right. Sorry,
Yeah,
not showing up for me. So,
yes, Ms. Earlston?
Just to add on to what the mayor's saying, when he's talking about, having the support of the council, I think, and to reiterate what Michael was saying as well, is we also need the support of the community. So I think that is a big part of our job as council members, is to get that, find out where the community stands on this issue and do our best to make sure we are representing them. I don't
Yep.
know, if we need to hold more community meetings individually, maybe with our wards, I don't know, but I think we need to get some feedback somehow. We need to work on that.
So we've done a great job, I think, of generating super majorities. Not that, I don't even know if that's the right word, but we've had almost all of our legislation have 6 or 7 votes. I think that's extremely important. So what I'd like to do over the next days or whatever is to make sure that whatever is proposed, if it's exactly like what we talked about tonight, that all of council and the supporters of the project reach out and talk to other council members, so that I think the worst thing after all these years of working on this project is to have it boil down to a real close vote where there's not a clear consensus within the community. So I think this proposal can achieve that. And so I think that's our next job, Doc or Tammy or whomever, is to get that strong consensus.
Mr. O'Leary, you mentioned some agreements with the Port Authority. Would that be between Mr. Palmer and the Port Authority, you and the Port Authority, in terms of, I think that's another avenue that needs to be kind of parallel with a consensus, the tripartite, get some, information to the community, council as a body, and then specifics with the Port Authority, so that, in a council presentation, you can have as many bullet points as possible.
I agree with that. I would think that their lawyer, meaning the port, and Thomas can work out that. Well, there's been conversations, Doc, kind of
Sure.
about the port's contribution to debt service in the first few years would be negligible, and as you went from years 5 to 10, the percent of the debt service that they would agree to absorb could increase, so that by the time you get to that 20th year, the port is paying most of that $350 a year. So
Right.
I think that's a very much a starting point, but not guaranteeing is the wrong word, but assuring that as the port is successful and this facility generates income, that income goes to debt service first, and to other expansions or improvements second, or down the road.
Right.
Yeah, and if I could add, I think what you would do, you would document that in what we call a cooperative agreement. And the cooperative agreement would be signed, for example, by the city, the Port Authority, the Freeze Fund. And it would outline what Tom's talking about, the waterfall, all the, the formulas or the aspects of who pays what when, and it all be outlined in a cooperative agreement, which is a very common document in our world, at least where we do economic development.
So if, I think we have just a multitude of items to think about, but again, I am encouraged by the specifics and the explanations. And Ms. Earlston, I completely agree with you. This is the first time that we heard level of risks, and we're happy about all of that information. So if there aren't any other questions, I'm going to,
I've
first
got
of all,
one
I'm
more.
going to ask,
Dustin, on it.
I'm sorry, Chad, go ahead.
Yeah, it's not really a question, but is another item that we need
Sure.
city's cooperation with. So part of our continued efforts in developing the whole free center and the site out there is some city infrastructure needs, which is the extension of the road from where it currently ends at the Valero out to the property, water, sewer, electric, all of that. What we're asking is that the city and the port enter into an agreement where the port will pay for the engineering study that needs to be done for that infrastructure. The city will obviously need to contract, I believe, McKeever and Associates, your engineering design firm, for those services, but that the port would pay for that. Because from what we understand, there are not currently funds appropriated at the city for that expense. And that's something that we could cover with our construction funds that we have currently.
Yes, Ms. Earlston?
Oh, just to clarify on that, Chad, water, sewer, the roadway leading back to, none of that is included in the money that we just looked at.
That is correct.
Correct.
Okay.
So what this plan would do, Tammy, is it would I don't want to say finalize, it would firm up what those expenses would be. Right now, it's just a guesstimate as to what that's all going to cost.
And you're thinking, and where are you thinking the money will come from to cover those funds? From the Port Authority? From
The city's going to be on the hook for the infrastructure.
Okay.
I wouldn't say that yet, Dr. Fellner.
Okay. I didn't know if I was overstating it or not.
I think there's opportunities to assist on those means or
Okay.
on those needs.
Do we have any estimates at all on the cost of that, roughly? I mean,
No, that's what we need that estimate for.
okay.
Yeah, I think if I may weigh in, I think from the port's point of view, they don't want to spend $80,000 for engineering for the three key components, the water, sewer, and roadway funds. Okay, if the city is not going to go ahead and bid the project. So one of the things that, at least that's my perspective on it. So one of the things that we need to do is, as Gary was alluding to, identify some funds for the roadway. But I think the short answer is water and sewer extensions, I think, are as likely as not to be a city cost. And I don't want to get into, it's been a good meeting and a long meeting, but the biggest cost that you would not perhaps expect is the movement of a lift station so that you can move the sewage from this site, also from Valero, and get it back to the city's sewage main line. So that's a cost that's out there that is a little more than one would expect. So I think I'm not joking around a little bit. I'm not as scared of what the sewer and water costs will be, but we've got close to $1 million worth of roadway costs from where dead end of Keller Drive and the Valero access point. So I hope that helps without giving you too much detail. I think what the port wants to know relatively soon is if we fund McKeever close to 80,000 for these engineering costs, will the city then go ahead and bid the project? In my mind, that's what it boils down to. And I think it's tied closely to the center itself, because if, there's no way we build this facility without having connecting utilities. So anyway, I'll stop at that point, but council's going to have to come up with those dollars or reach out to other resources that I think Gary's referring to.
But to Chad's question, it starts with getting those engineering estimates, which if the city contracts with McKeever, we can pay those through the state capital bill monies that we received, the 500,000 that we've used for the criteria architect for taking down the trees. So that 1.2 million that we've already brought in through the Timken, through the state capital and the community foundation is what is getting work done currently.
Yeah, I think if we're gonna build this project we spent an hour and 20 minutes on, then we have to get an agreement between the port and the city about funding this infrastructure. So I think that all of a sudden, I'm glad Chad brought it up. That queues up on the front end. We'll have trouble getting construction equipment to the site if we don't have an agreement among council to go ahead and build the roadway and commit to the infrastructure. So I think we agree on that, Gary, right?
Absolutely.
I think so.
Okay, fair enough.
Okay, more to chew on.
Yeah. And we will probably, Doug and I will talk about the presentation that we provided to you all and think about doing like a break-even presentation as well. Just that we talked about, we got all the numbers all mixed up and things like that, but try to make that a little more clear for you all.
Thank you.
All right,
I just want to thank you guys. I think you did a great job and
sure, thank you.
it really helped, like I said. So I appreciate you guys coming and doing that. It was very, very
Sure,
enlightening. Thank you.
yeah, yeah.
So
We
in addition to
appreciate working
Michael's
with you
next,
guys. Yeah, go ahead.
in addition to Michael's next steps, what are the next steps through Economic Development Committee to council to conversations?
I think that kind of an ongoing discussion with Mr. Palmer and the Port Authority's attorney for some agreements, talks amongst council people to, solicit, explain what we did here tonight, and, ultimately get some legislation in the works in the next period of time. We've got not another meeting for a month, but I don't know. That's a long way away, but it's also a short period of time to get things that need to be accomplished done. So.
Hey, Doc, the only thing I would add briefly to that is that finance, we're gonna have a number. I know Gail or Eudes, like their hair will turn gray over this. We're gonna have some budget adjustments, and to move forward with the engineering, but more importantly, to allocate money for construction, we're gonna have to tweak that budget. So I think the conversation perhaps comes back at finance, where we talk about supplementally appropriating water, sewer, a little bit of storm sewer, but more roadway and electric. So we can revisit that tomorrow night in terms of where we put money in place to build this infrastructure and get it done this year. there's not enough money in the budget at this point. So, thanks.
Okay, I guess we're going to talk about this again tomorrow, so.
I think trio.
Okay,
Well, my only question, because I was following Tom, but then I got a little lost because you're talking about the actual construction. What about the engineering? Can that move forward?
You know, Gary,
With-
I think, I think that's in there, but I wouldn't, from your point of view at the port, until council says, yeah, we'll build it, I wouldn't use your capital money to pay Lynn. I think I want to get a
Okay.
commitment out of council to go ahead and bid it. You guys design the plans, we'll sell the project. So I hope that helps clarify that.
okay. Also, Michael, I'd like to extend my thanks for explanation and the presentation tonight. That was very helpful. Andy froze. Are we gonna talk about any more, or are we gonna motion for adjournment? I guess, Ms. Earlston?
If there's no more discussion, I can make a motion to adjourn.
Ms. Earlston makes the motion.
Okay.
Mr. Ivy seconds. Before we take a vote on that, I'm not a botanist, Mr. O'Leary, but is your ficus okay right there over your shoulder?
No, it's very unhealthy and we
Okay.
are trying to keep it alive. So,
Okay, well, good.
nice
All in favor
observation.
all in favor of the motion to dismiss the meeting, say aye.
Aye.
Aye. Thank you. Meeting
Good night,
adjourned
everyone.
at
Good night.
8:22.
8:22.
Okay,
you're
good
still
night,
on-
everybody.
You are
Right.
the bomb.
All right. Thank you, everyone.
You're the bomb, Michael. Thank you so much.